Welcome to Excess Returns, where we focus on what works over the long term in the markets. Join us as we talk about the strategies and tactics that can help you become a better long-term investor.
Justin Carbonell and Jack Forehand are principals at Validity Capital Management. The opinions expressed in this podcast do not necessarily reflect the opinions of Validity Capital. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Validity Capital.
Hey guys, this is Justin. In this episode of Excess Returns, Jack and I sit down with Alejandro Lopez-Lira of the University of Florida and Andrew Chen, financial economist at the Federal Reserve, to discuss their findings in their recent research paper, Peer Review Theory Does Not Help Predict the Cross-Section of Stock Returns. In the paper, the researchers looked at the major stock market anomalies identified in the academic literature, i.e. momentum and value, and the performance of those both in sample prior to the academic identification of those anomalies, and then out of sample or after publication. They then asked, what if they use standard accounting data and machine learning to data mine for anomalies over the same in and out of sample period? Their findings were very interesting and have some academics and factor-based investors thinking of the possible implications of their research. As always, thank you for listening. Please enjoy this discussion with Alejandro Lopez-Lira and Andrew Chen. Andrew, Alejandro, thank you guys very much for joining us today.
Thank you. Thank you for having us here. Yeah, our pleasure.
Most of our audience knows Jack and I quite well. We've done a lot of these podcasts, but Jack and I are the furthest thing from people with PhDs in empirical finance. But we are involved with factor investing. And so, even when we initially saw this paper, we found it very interesting. And the title of the paper is Peer Review Theory Does Not Help Predict the Cross-Section of Stock Returns. And we wanted to have you both on, which we really appreciate, to talk about the paper. It was interesting. We had one of our friends who's done a few of the podcasts with us. He's a PhD, and he's involved in the asset management business. And it was funny when we were talking to him about the paper, he was basically telling us that he reads like as much as he can in the empirical finance, these studies that come out. And he basically said, all this stuff is the same. But when he saw your paper, it really struck him and he found it really profound. And it really made him, he found it like very interesting. Like it really stood out as being something that's unique. And you were really digging in and questioning the basis for what, a lot of this stuff is based on. So anyways, that's kind of the where we'll go today. And our audience tends to be more, professional and retail. So we're going to try to keep it at the level of not PhD level, but, we'll get into some of this. And I think this will be a really great learning experience for everyone listening. To start, let me ask you, and if one of you or Andrew, if you want to sort of give your little disclaimer here about the Fed, that's fine. You can just drop that in. But maybe to start, what gave you guys the idea to tackle this subject?
Justin, thanks for prompting me. These views, of course, are not necessarily those of the Fed or the Fed system. But how this started was we're working on a different paper, and I just wanted to write a sentence that says something like, most anomalies papers attribute the anomaly to mispricing. And then I was like, I don't really have proof of that. So, I had in previous project replicated a ton of anomalies papers, so I'd read a lot of them. So I knew what they all said, but it seemed like someone should actually go and count like how many of them are due to risk or mispricing according to peer review.
Then I think Andrew found a very interesting graph where if you plot the returns of data mine strategies that we were working for a different project, they look very much similar to the returns of published strategies, like these published anomalies. And we normally think there's something special about academic strategies, so we were kind of surprised and just tried to make that the focus of the paper.
Yeah, there was another project that kind of got merged together where we're interested in how to do data mining correctly. So we just started mining data, and then Alejandro just described the result. They look really similar, data mining and the peer-reviewed stuff.
We want to just kind of lay a little bit of the foundation here because some of the terms that we're going to be using our audience might not be that familiar with. So let's go back to just defining what an anomaly is in empirical finance. How would you guys describe that?
It's funny, anomaly is like a controversial term. It's like asking what is a feminist or something like that. People are going to argue about it, but basically it's some kind of stock market predictability that is hard to attribute to fundamentals, to risk.
My impression is very similar, is that to me, an anomaly is a return pattern that cannot be described by existing models. So, before when we had like a CAPM, if you find any return that could not be described by CAPM, then it was an anomaly. Then people started playing around with adding like more factors to explain the returns. And if you could not explain some specific portfolio with those returns, then that became an anomaly. And, the general thing that I would say is like, it's whatever we don't know how to explain.
So Alejandro, you just sort of use the word factor, which is one that our audience will be pretty familiar with because you see it all over investing these days. Like, what is the difference between an anomaly and a factor? Or is there one?
Andrew, do you want to start?
Oh no, you should go ahead with this. You're thinking about this. You have papers on this. I'm a bystander
Okay,
here. I'd rather let you do the work.
there is a lot of confusion with the word factor. I think it's one of the most problematic words in finance, because it just comes from different varieties. So, we have the factors coming from statistical factor models, and we have the factors that are used in finance. I think the main difference is that a factor should be able to explain the returns and should have like some background on economic theory. Whereas an anomaly is just something that should not be described well by economic theory or by like financial theory. Now, there is this interesting link where arbitrage pricing theory that I don't know if you remember from the previous podcast, but I'm a little bit against. Kind of says like, well, whatever long short portfolio that has like some expected return and doesn't have like zero variance, that can be like proxying for a factor. So it's a little bit complicated, but basically, factor is what we treat as explanatory variables. It's almost a matter of convention, and this just leads to a lot of confusion. Yeah.
And I can pretty much guarantee you I'm going to interchangeably use those words and screw it up throughout the rest of this podcast. So people can make fun of me about it afterwards. But getting back to the idea of anomalies, there's been a ton of academic research dedicated to this idea. Why do you think that is? Why is this something that's important to study?
Well, I think it goes back to the debate about market efficiency. That was pretty much the dominant framework in the like starting from the 70s and through the 90s, and it just took so much, in my view, so much detailed evidence in order to kind of push the academics toward thinking about a different perspective.
Yeah, and I think there's also practical implications, right? Everybody wants to beat the market in some sense, or beat whatever benchmark there is, and anomaly is kind of like an offer, like a reasonable path to do it, right? Like you just load on these variables or load on these factors, and then if the current model cannot explain it, you'll outperform the market.
And so can you guys just talk a little bit about, I mean, people are going to be familiar who listen to us probably with Fama and French, but can you just talk a little bit about the body of work that exists in this area, like leading up to where we are today?
Well, I mean, the body of work is huge. Let's see. I suppose it's really started with perhaps the earliest is Statman's. Like Statman, this master's thesis documented book to market in 1980 that it predicts returns, and then they found size predicts returns, Bance in 1981. Fama and French, their big contribution is to try to unify this, to try to rescue efficient markets, basically. These were kind of exceptions to this efficient markets idea, and Fama and French put on this framework for thinking of these not as anomalies, but as factors. And then after that, there became more and more anomalies. It seemed like those were just the tip of the iceberg. Now we have these public data sets which have replicated like 150 or even 200 anomalies. And I think right now that's kind of where we are. It's kind of like the factor zoo, or like if you've heard of in physics, there's the particle zoo. People want to unify things. It's human nature, but sometimes the world is more complicated than that. And I think that's where we are now.
Yeah, no, I think that was a very good summary. So like, just I would just add that basically an anomaly depends on what kind of model you're using to price. So the history of anomalies is just related to the history of factor models. So before, again, like anything that was like beating the market was like basically an anomaly. And after Fama French, well, at least you had to show that your strategy was a little bit different from what those factors were like using, right? Like if you were using like size or like value, like sure, you may beat the market, but like that doesn't really count like a overwhelmingly good strategy.
Like in our world, those things kind of became beta. after they were published. They're not any. There's no longer, you can't just be like, oh, I'm going to use a basic value strategy and I'm going to outperform. Like, that's great. Charge a high fee for that. Like, it became different. Once they're published in the research, once they become widely available at low fee, they become different than they were before.
Yes, absolutely. And that's, we'll speak a little bit more about it later, but basically the return predictability of most things just disappear after the year 2000 and something, and the early 2000s. And the main reason we think is that, market becomes more efficient. It became so much easier to load on this type of momentum strategies, size strategies, book to market strategies, basically whatever you want. Like there's almost an ETF for that. So if investors can bet like more easily on those kind of things, we would expect those abnormal returns to disappear going forward.
So working closer to the work you did in the paper, when we talk about factors, you'll always hear two things, in terms of explanations as why they work. You'll hear a risk-based explanation and a behavioral-based explanation. So before we get to the paper, can you just talk about what those are?
Sure. So I guess the behavioral explanations are easier to understand. This predictability is due to some kind of mistakes. The simplest one is that people are sluggish to incorporate this information. That's behavioral in the sense that in like if people were perfect and not subject to biases and slowness, limited information capacity and things like that, then the market will always have the right price and there would be no predictability. So that's kind of the behavioral story, that there's imperfections in the market.
Momentum would be a good example of that one, right?
It's actually even there are rational stories for momentum. That's kind of one of the things our paper touches on is there's huge rewards in academia for like rationalizing, providing a risk-based explanation. The paper is by Sagi and C. Scholes in the JFE. They provide a rational perspective. My advisor also has a rational paper on momentum. But I think you're right. In general, people think of momentum as a behavioral issue. Like people pile on to returns, they extrapolate from past returns to future, and that causes the return pattern.
So I'll take a tackle of the risk because it was my class today, so I'm a little bit fresh with material. So risk-based explanation is that you get compensated for varying some systematic risk. Like we've all heard that diversification can just drive away each firm's specific risk, right? Like, so you should not be rewarded in any case, right? So the opposite side of that is like, well, if you have any differences in predicted returns, in your expectation about how good these investments are, it better be because it's loading on some source of risk, right? Like if you're taking like a very good deal that has like, I don't know, like 25% average return per year, it must be the case, or at least we think it must be the case, that there's some underlying source of risk that you're taking on when you take that investment, right? So that source of risk can be like, market risk, for example, or it can be any other risk related to the economy, yeah? But the main idea is that all of these high average expected returns are linked somehow to taking more risk in an unspecified sense. And the classic ways is like, well, it may be the market risk. It may just be like, covariation risk. Like sometimes industries move together, like you are also suffering when industries move together. So you may get a little bit of compensation for that. Although historically industries do not get that much of a return.
And is one of those considered stronger from a persistence standpoint? So if I expect something to persist in the future, like would I rather have a risk-based explanation, or would I rather have a behavioral one, or do I not care? How do you think through that?
I mean, it's a subtle question, because if the risk-based explanations apply to you, then that doesn't mean that you want to trade on it, right? If it's this kind of strategy has high returns because it'll collapse when you lose your shirt, then it's not a good thing for it to continue. But if that's actually the way that it works, if that's really what's the underlying phenomenon driving that return pattern, then it should persist, right? People will avoid these stocks because those stocks will pull you under. On the other hand, if it's just a behavioral issue, those things will get corrected pretty quickly, presumably, if the markets are as fast as they are in modern times.
Right, because it's relatively easy. If you give me any strategy, like whatever strategy you want, I can come up with a rational model for it. Like I'm sure, like I can just spend like a day or two just working at the math and giving you like a very nice rational story, right? But the point, and I guess later we'll talk about it, is like do these stories matter at all, right? Like, is this like, is me like writing an explanation going to have like any impact on that? Although before jumping into that, I would say that generally speaking, you would expect, as Andrew said, like risk-based strategies to persist, just because people are happy to, have that level of average return for that level of risk. So we would not expect new people to just enter the market like crazy. Whereas if you have like a really, really good deal, we would expect investors to just try to take it right away. So in some sense, the prediction from classic theory is that, well, if you have a risk-based explanation, it should persist. And if you have a anomaly-based explanation, it should just decay relatively quickly.
So just one more before we get into the paper. I want to ask you about two words that I was told when I was learning about this as a researcher. I was told that I need to avoid at all costs, which are the words data and mining. And I think that might be changing a little bit, which we'll get into later. But I'm just wondering if you could define what data mining is.
Data mining is just looking through data for interesting patterns. That's all it is. I guess maybe the key aspects to it is that it's usually unguided by any theory.
I would say the same thing. Like, the defining explanation is that you do not have any structure on the data. You're just looking for patterns. And I think historically, it was seen with bad eyes, because if you just focus on your current sample, you can, fit anything in the data. You can find as arbitrary patterns and make as high returns as possible, etc. Right? But the trick is like, will this work out of sample? Will this work once I move to the real world? Once I move to a different time period? Once I move to a different country? So we're mostly interested about like the out of sample properties. And I think with machine learning, it has been relatively easy to see that data mining is actually very useful. Like, all you need to do is basically training one part of the data, like study that part of the data very well, and try to obtain patterns that generalize as much as possible to apply those in an out of sample, either period or country.
When we look at something like value or some of these factors we know really well, I mean, were those a function of data mining? I mean, in other words, did the reason come after the fact for those? Or, did we figure out they worked and then try to come up with a reason? Or I'm just not sure, like the chicken and egg type thing. How did that work?
I think it's a chicken and an egg issue. It's unclear. If people write down some things in the paper, but they don't write everything. I'm like thinking about Satman's paper, and I think he motivates it by pointing to kind of industry talk that this is an idea that if the book value of your stock is high compared to the market value, well, then the market value has to go up and adjust. He kind of talks about it from that theoretical framework, but we don't know if he really looked at the data first.
Yeah, and I think for size, for example, I think we have the quote from like Vance 1981 that basically size exists, like the size anomaly exists, but we don't really know why. And those are almost the exact words in the paper. It's like, to summarize, the size effect exists, but it is not clear it is not at all clear why it exists. So, sometimes people just document patterns. Sometimes they put a theory on top of it. Yeah.
So now that we've laid the groundwork, now we can actually get into your paper. Can you guys just talk at a high level about what you were looking at in the paper and what you did?
Let me give that a shot. So you could think of, there's at least four ways to come up with an anomaly or trading strategy with unusual returns. One is to think about risk and try to think about the sources of risk, and then to identify exposure to that risk. Another one is to think about mispricing and behavioral biases and think about which stocks will be underpriced and overpriced. Another one is to kind of do a combination of both. You're not really sure which it is, but you do a robust enough job that you can get published in a top finance journal, which is very sought after in my community. And the fourth thing you could do is you can just mindlessly search accounting data and look for trading strategies. Just look for anything that worked well in the past. Just naively backtest like everything that you have. And you would think, based off of just the difficulty of these things, it's so easy to naively backtest compared to come up with a risk-based theory that you publish in a top journal. You'd think that going through all those bells and whistles, adding all those bells and whistles, jumping through all those hoops would get you something in terms of how the performance of that strategy looks after your original sample. So we're going to compare. What we do is we take these four different ways of making anomalies, and we compare like the in-sample period, so for Sam French's famous papers in 1992, we'll compare the data from 1963 to 1990 to the anomaly returns after 1990 until today. And you would think that if you do all that work, you would get better out of sample performance. But it turns out that the answer is no. It's about the same, no matter what all those 4 different approaches lead to about the same kind of out of sample performance.
Yeah, perfectly well said. I would say the other Andrew has a very nice thought experiment. I'm going to change it a little bit so it resonates more with the audience. But suppose you have an analyst that comes to you and tells you, well, hey, I found this strategy that has like a very high t-stat, like a very high statistical significance, like above like 3, right? And it has a very good average return. And then you ask like, okay, how did you come up with it, right? And the expectation is that if the analyst tells you, well, I just, I actually have like this theory about how this type of firms should be underpriced because, it's just hard to value this specific metric. You would normally expect that strategy to perform differently. That if your analyst just tells you, well, I just tested 10,000 strategies and this one that had like the highest, one of the highest average return and one of the highest t-stat. Normally Andrew tells it with a PhD student, but I guess it's more clear with the analyst. And, it's actually an empirical question whether these 2 strategies would perform different, right? We would really expect that the theory one should do better, but it's something that we're trying to test in the paper.
Yeah, it's interesting in our world too. Like if you're going to a client with an investment strategy and you say, all right, we're buying cheap stocks with a PE ratio, that's very different than saying, oh, we divided inventory by cost of goods sold, and telling them that though there's really no difference in terms of how those are going to work going forward, even though one makes a lot of sense and one makes 0 sense.
Yeah, the result is pretty shocking all around. I think it's perhaps even more shocking for people like me who are trained in asset pricing theory. My dissertation is a model of the value premium with like heterogeneous firms that you have to use Fortran to solve because it's just hard to find exactly what equates makes all the numbers in the economy add up. All this work you do, and in the end, it might as well have just naively backtested.
Alejandro, you referenced the term t-stat. Can you just explain that and sort of what a good t-stat is? Because a lot of our viewers may not be familiar with that.
So whenever you're trying to assess the performance of a strategy, you would normally care about how much return it gives you, right? Like the average return that you would expect to get following this strategy. Yeah, you're going to use the average return as a measure of that. And the first thing to do is like note that average return is going to have like some variation, some uncertainty surrounding it, right? Like you don't really know if maybe you just got lucky this period and you would just expect by chance that this kind of returns like sometimes happen. Like you kind of want to know if that's probably going to be happening in the future. Yes. So the t-statistic is a way to kind of like formally test whether your average return is different from 0 or not. Normally you want to test whether if it's positive, but if it was negative, you could like short sell it. So let's just say that it's just going to test. It's going to be a formal test of whether your average return is going to be different from 0. Yeah. And the idea is that the higher the t-stat, and Andrew will correct me for sure because this is his area of expertise. The higher the t-stat, the less it makes sense to attribute this return just by pure luck. That's roughly the way I would describe it. But I would beg Andrew to come in and help me with the explanation of t-stats.
Yeah, that's good, right? It's just basically your alpha or your performance measure divided by the uncertainty in your performance measure. We usually call something significant if that ratio is above 2. So you're kind of like twice. It takes 2 levels of unlucky draws in order for this to be 0, something like that. And then I think in the literature you usually find t-stats of about 3.5 is typically quite common.
So in terms of the data mining you did, how did you determine, like you tested a lot of different combinations of accounting variables. How did you do that? I mean, did you just randomly, it was always one variable divided by another, right? And how did you figure out like what you tested?
So it was, we did 2 kinds of transformations. We did one variable divided by another, but then you also want to get first differences, right? You also want to get changes in assets, not just the level of assets. So you also did first differences of a variable divided by another variable. And we just looked through everything in the standard data set that has sufficient observations. The standard data set's called CompuStat. It has about 240 variables with enough observations that you can just do this. And if you do the combinatorics, it's always shocking to me how many numbers come out if you just combine every possible combination. And that, just doing this will lead to like 29,000 different trading signals.
So were there any like restrictions in terms of like what could be in the numerator or the denominator, or you basically just tested everything?
We basically tested everything. We don't want to divide by 0 because that's very confusing. Not really sure what to do with that. So aside from trying to avoid dividing by 0, we don't really have any restrictions.
Yeah, it was only making sure that the denominator was positive in 1960 something. So like the first year we have in sample, if like more than 25% of the companies had that variable positive, we would just assume that variable is positive, and it would be fair game to divide by that variable. We didn't even take a look at which ones were there.
I mean, I guess the only thing to add is the accounting variables are not like they're not like random numbers, right? They're not meaningless. They are by definition variables that investors want to know. So in this sense, what we're doing, this data mining is structured. It is purposeful.
And did a lot like the things that work best in the data mining, did that overlap at all with like the factors that a lot of us know, like the ratios that a lot of us know that we would use like in everyday investing?
It basically picked up a lot of themes in the literature. This was something it was somewhat subtle. We decided to just kind of be snarky, make a table that compares strategies that we found to famous strategies. It was originally just to be snarky, but then when we started presenting it, people point out, hey, that's actually the investment anomaly, and that's actually the accruals anomaly, and there's the issuance anomaly. It actually just pops up from kind of naive backtesting.
Yeah, and just looking at some values. So we do have like some things that naturally comes up. So like things divided by price that roughly look like a book to market, but with other numerators, and also just other variables that you would normally not expect to see. So like for example, interest expense divided by cost of goods sold. That was one variable that predicted returns. Could that be related to leverage or operating risk or something? Like sure, there's always a way to explain these things away if I don't need to test the explanation and I just need to write the story. But we found like some things that it's not that it's impossible, but it also doesn't come to your mind, like equity liquidation value divided by the lag of current liabilities. I guess that's just leverage. So some of them I would say, these are all accounting ratios, so you can come up with a story for any of them. So all of them look like sensible, and there's going to be some groups that are going to look like value, some groups that are going to be like leverage, some groups that are going to look like investment. But in general, the interesting thing is that all of these have the same average returns in some cases. So right now I was reading from the strategies that look like size, for example.
So let's actually, you reference these charts in the paper, and they're really cool. We're going to put them in the video. So let's look at this. You have one here where on the top you have the book to market, and on the bottom you have a bunch of data mined factors. Can you just explain what we're seeing here?
So when we want to make it a fair comparison between the academic stuff and the data mine stuff, we don't want to compare a data mine variable with a t-stat of 10 to an academic variable with a t-stat of 3. And we just want to have a level playing field. So then we look for anything in our data mined strategies that had similar performance to book to market in Fama French's original sample. So that's from 1963 to 1990. During that sample period, a book to market had a return of about 96 basis points per month. And then we find that there's 171 of our data mine strategies have a similar performance during that sample period, like between 67 basis points per month to 115 basis points. That's like roughly comparable. And then we just list like 15 or so of these variables that have similar returns. And as we were just describing, a lot of these pick up themes that people have talked about in the literature since Fama French 1992. Like a number of them are related to change in assets, which is a lot like investment. And there as part of the Femme French 5-factor model, there's investment now in there, and there's also like change in receivables is like accruals, and the other anomalies you can see in there too.
Yeah, and I think I think this exercise is very interesting with value because you don't cover certain themes. But to me, the most surprising was when you try to do this with momentum, right? Because there's all of these academic papers written about momentum, and we think there's something special if you're sorting on past returns. And when we look at the specific tables, we actually see that there's a lot of accounting teams that just are going to match the performance of momentum, like within the sample period, and the average of those strategies is going to be close to the out of sample period too. So things like difference in assets divided by lack current assets, that's going to be something that has similar performance to momentum in sample. Or, property, plant, and equipment and machinery divided by current liabilities. Yeah, so there's going to be a bunch of things that look with very, very high average returns, but have a completely different explanation, I would say, than this momentum strategy.
I think the kicker to these tables is if you look at the rightmost column that shows post the out of sample performance, the returns after Femme and French published their paper in 1992. So book to market, the performance declined by roughly 50%. That's roughly representative of most anomaly variables after publication. It's 62 basis points out of sample compared to 96 in sample. And then if you look at the data mine strategies, on average, they have a very similar decay. Well, actually, they decay even less in this example. The decay is from 83 to 69 basis points. So that says you could have, if you could actually implement these strategies, where there's a big asterisk on implementation of these strategies. But if you could actually implement these strategies, you don't need those Nobel Prize winning insights. You could have just asked your intern to gather all these accounting variables, don't divide by 0, and look for stuff that has good returns in sample, and you would have outperformed all that human capital.
It's so surprising because we allocate so much time in academia to discuss like some very specific like variables, like book to market or momentum, but there seems like to be well, it's not infinite, but it's a very, very large amount of like things that we could have studied instead if some researchers decided to look at a couple of different things instead.
I do find it very interesting that, even in the data mined at a sample from 91 to 2021, that those, probably nobody was following most of those strategies, and yet the performance kind of significantly declined. And I'm wondering if you have any thoughts or ideas on why that might be, but as a sort of just more of a testing question for you. And I don't know if this is going to make sense or not, but you could chunk out those periods of time, like from 63 to 90, 91 to 2001. There's a lot of different market regimes and investing environments and, different styles of investing. And obviously information flow is, different than it was back in the 60s and 70s. And it's kind of sped up, but I'm wondering from like a testing standpoint, can you like randomize, or would it ever make sense to like randomize the months so that you're not going consecutive years, but you're more randomly looking at these anomalies, across just a randomized set of months? And I wonder if that's something that even would make sense, or if that question is that.
I guess, yeah, it does. What you're describing is kind of like a general cross validation, right? Instead of, right, what we're doing implicitly here is you test in the past, you train on the past and you test in the future, but you could instead just hold out a certain decade as your testing zone and train on everything else. You could do that. I suppose usually how cross validation is used is to try to find the more robust patterns, and that should be presumably persist across different market regimes is kind of what you're hinting at. But I think for our purposes of this exercise, we really want to kind of fix in time what the academics did. Like that is kind of, that's like the natural benchmark, is to say like they knew everything that happened in the world up until not everything, but they knew what happened in the world up until 1990. They don't know what happens afterwards. So we need to see what actually happened. And this is, it's not just something that we're thinking about. This is in the key PhD textbook. It's a wonderful textbook, but a key message of the asset pricing book by John Cochran is that we should try to make sure we avoid data mining bias and that we actually have robust factors that perform out of sample. We actually want to understand the theory and the risk, and that's what we're really going after.
Just to go back to this momentum chart, I just want to make sure I have this right. So what we're saying here is if I was like starting an investment strategy today, and on one hand, I was going to run one based on 12-month momentum, and on the other, I was going to run one based on PPE and machinery divided by capital expenditures, I really would have no reason to suggest one would do better than the other going forward. Is that correct?
Yeah, in fact, momentum has been more talked, so I would expect momentum to decline faster, if you ask me, than a random data mine strategy. But again, all of these are, let's say that you would expect the average return to be similar going forward, I guess, if you just pick randomly.
I think Jack is forgetting that we've had Sheridan Titman on the podcast, so
We did, yes. I'm more thinking like if we went to market with our PPE and machinery divided by capital expenditure ETF, we're probably not going to get too many potential investors that are going to look at that thing. But realistically, it might do just as well as if we went with a momentum ETF.
Well, I could come up with a strategy
based off this. That's what this table says, right?
Maybe we could get a bunch of academics to invest in the PPE and machinery one because they would understand behind the scenes that there's really no reason it's a less crowded area and there's really no reason it should underperform.
It's always easy to come up with stories after the fact. Like I'm pretty sure if you give me like 5 more minutes, I'll come up with a story about how PPE and machinery divided by capital expenditure is related to investment. And we all know that macroeconomic shocks affect investment performance, and hence it's not that you are not taking any risk, it's that your risk will be realized.
As someone who spent his dissertation studying asset pricing theory, it's not easy. It's hard. It's very, very hard to come up with something like that. But people can come up with it. I can't disagree with that. I think people are really talented at making theories.
I think Alejandro, we'll have to have you come back on for the lightning round where we basically just run off factors and you can explain in real time, come up with an explanation after the fact.
There you go.
That would actually make for a great podcast.
Sure.
I want to ask one other thing. You did also, in addition to the accounting variables, you also did do a look at some ticker-based data mining strategies in the paper. What did you find with those?
We found that if you mine tickers, following the same kind of idea that you look in the past, look for ticker-based strategies that perform well, on average, they do nothing in the future. So there's something really special about mining accounting variables, or perhaps something very unspecial about tickers.
I want to shift and ask you guys. This gets to some of the stuff we already talked about, but there's a great chart you had in the paper where it was 3 different charts. You had a risk-based chart, a mispricing-based chart, and then an agnostic chart. And you can I just wanted to maybe see if you could just talk a little bit about what we're seeing here.
Yep.
Okay.
Sure. So in each chart, we start with like the published line, which is, for example, in the risk-based chart, it's the performance in and out of sample for published strategies based off of risk. And then in the red line, we have a matched data mine line. So the matched data mine predictors are matched similar to those previous tables you were talking about with book to market and momentum, where we have the same snapshot of time that those researchers had in 1992 or 1991, and we look through the past and mine accounting variables, and we come up with that red line, stuff that performs similarly in sample. So in sample, they're similar by construction. And then the big question, the question of our paper is what happens out of sample? What happens in the future when you're actually trying to predict instead of like predict with quotes around it? And what you get is the same performance, roughly speaking, that the blue line declines, the red line declines. Out of sample, they both decline by very roughly 50%. Although if you look at the risk-based one, it might kind of underperform.
As Andrew said, the interesting thing is that the actual decline pattern follows the ones in the published literature. Like it's not only that they decline in percentage, they roughly seem to decline at the same time and at the same level. It's not that both of them decline. It like the way they decline looks like very, very similar.
Like I can kind of understand the published anomalies underperforming once published because it would make sense that assets would start to come in But do you have any thoughts or ideas as to why the data mined performance is possibly
Sure.
less?
Yeah, I mean, there's at least three different ways to think about it. One is that the simplest one. I'll just start with the simplest one. The simplest one is that the anomalies literature really peaked around the mid 2000s, and it's after that time that information technology really blew up. I asked this pretty senior professor, like, how did people trade book to market in the 1980s? They had to get the accounting statements through the mail, didn't they? And he's like, well, I guess so. And now it can be just fed into a computer, and people even fight over the shortest distance to the servers. So around 2005, there was a big change, and so that would lead everything, all sorts of accounting data, to be impounded in stock prices faster. Something embedded in this whole literature is that there's these assumptions on when you're allowed to trade on these accounting variables. And according to the rules set down by Fama and French that we all have to abide by as academics, you're allowed to trade on these variables about 6 months after the fiscal year end. And so now it takes much less time than 6 months after the fiscal year end to impound that stuff. I think the other aspect of it is that there's a lot of these variables they're just kind of proxying for more micro stuff that I think, for lack of a better word, real life investors are working on. So to even though someone who is doing equities research and finding some particular story about why this one firm is going to outperform because of its clinical trial or whatever, that those clinical trial results, they are quite likely correlated with some of these accounting variables, and it is through this searching data that you can see the same patterns that humans see with their own eyes. I don't know, Alejandro,
Yeah,
did you want to add anything else?
yeah, for sure. We've talked about it. I think the other explanation is that investors were actually looking at this kind of like accounting variables, like explicitly, like not only they were looking at assets in general, but they were looking at how well this predicted this difference in assets divided by like SG&A can predict returns, right? And it just happens that roughly both academics and investors get confident of the signal at the same time. Like once there's enough statistical significance to know that a signal is like credible, academics are going to write papers about the signal, and investors are just going to exploit it. So I'm pretty sure there's a lot of hedge funds just constantly looking up for new and interesting signals to exploit. Once if these signals are public enough that academics can write about it, then academics are also constantly looking for things that have like high t-stats and average returns and are amenable to a nice risk-based explanation or a nice behavioral explanation. So if investors are competing in the stock market while academics are competing with ideas, we would roughly expect that, at the same time that the signal is strong enough so that academics realize and write a paper about it, investors also by that time know that the signal is strong enough to trade that specific signal.
So there's a chart. I just want to jump in real quick. There's a chart that speaks to what Alejandro's talking about, like that story. The chart looks at the trailing 5-year return relative to the sample period ends, and you kind of see the trailing return is increasing and increasing and increasing, like gradually until when the original sample period ends, and after that it declines. And that pattern appears for both the published stuff and the data mine stuff. So it looks as if evidence starts building and then people trade on it and it goes away.
I just wanted to read before I hand it back to Justin, just to get at the conclusions of this. I wanted to read one quote from the paper and get you guys to comment on it because it was kind of eye-opening for me. The quote is, "Economic theory helps predict returns if it provides information about expected returns. Our empirical results imply, unfortunately, that theory does not provide such information. Though these findings are negative for economic theory, they are positive for data mining. As shown by Yan and Zhang, data mining uncovers true out-of-sample predictability." So can you guys just comment on that?
Where to start? Like we are taught that data mining is bad. It's a bad word, right? You should not even think unclean thoughts like that you might be data mining. And I feel like the world might be changing. At the same time, that what you're supposed to do is be a good student, write down preferences, write down equilibrium, define equilibrium, solve for equilibrium, and then you can understand how expected returns work. But if that actually provided some information about expected returns, we wouldn't see this kind of out of sample performance that is the same regardless of whether you go through all that work. So the bright side of it though is that I think we're seeing in a lot of other fields, like in linguistics and in protein folding. So in linguistics, for example, you don't Alejandro should probably talk about this one, but you don't you don't feed Noam Chomsky's theories into the neural network, do you?
No, no, no. All of this. I think what Andrew is referring, like like models like ChatGPT do not have any underlying theory on them, but of course they're just like complex functions of the data. So I guess we're kind of approaching a world where we're happy to say that the world is complex. We have a lot of data, and we're just going to try to use that data as best as possible. In theory, ideally theories should provide a good prior of what's happening in the world, right? But it's only helpful if that theory is correct, or if that theory is like helping in any such way. Most of the cases, whenever you're proposing a theory as an academic, you need to kind of like simplify it enough so that it's represented in a tractable model and solve for it, right? So you lose a lot of the world complexities. Because of that, it may just be better to just embrace, kind of like this machine learning framework, this data mining framework with out of sample returns, where you let the data speak by itself. Like you don't want to impose like any kind of like big, strong assumptions other than, well, you know what, we're going to look at accounting data because accounting variables are informative. But as after that, like, do you really think better if like past returns divided by lag expenses is better than property, plant, equipment divided by lag accruals? Like there's even though I can come up with stories for both, it's probably not the work that humans are suited to try to understand these predictability patterns, and it's just better kind of like apply the most sophisticated statistical techniques, machine learning, data mining, Bayesian regressions, etc., to try to exploit most of these signals.
I want to give a caveat, if I could, about the theory that we're talking about that we focus on in the paper. Is in the title. It's called peer-reviewed theory. So for your audience, these theories are probably things that they generally have not probably even heard about, much less given a lot of thought to. The simple theories, like the simple theory that it takes time for information and accounting variables to be impounded as stock prices, and that they're when the frictions are reduced, that the predictability will become weaker. These kind of ideas that are probably still extremely helpful. They're really not the core of the paper. The core of the paper is about the stuff that gets published, the stuff that will help you get tenure at a major university.
Yeah, so we're focusing on a very specific subset of signals, right? We're focusing on signals that you can construct easily by using like accounting ratios, for example. There's nothing that special about those signals, and there's no particular reason why academics would discover some of those signals, but investors would not uncover those signals themselves, right? Like anybody can go ahead and test whether property, plant, and equipment divided by lag R&D is gonna be helpful or not. So in that sense, our paper is not saying like, as Andrew said, not in theory in general, not about this is statistical theory or general theories about limits to arbitrage, etc., but rather these specific theories that propose a new variable formed with accounting ratios based on an economic model, for example.
It's funny that this is a totally different world because they're short-term traders. But when I was reading your paper, I was thinking about this quote from Robert Mercer from Renaissance, and the quote was something along the lines of, "Some of our factors that perform the absolute best make the absolute least sense." And I was thinking, like, is that going to start applying to our world now in the longer-term world? Like it is implied to their short-term world, in the past.
Yeah, our discussant at the recent AFA meetings pointed out a quote from the man who solved the market, where he basically said that they also took the data mining perspective. They eventually relaxed on having a theoretical explanation, My response was that it's nice to be compared to Jim Simons, but I wish I was as rich.
Have you guys given any thought to sort of follow-up research to continue to sort of build on this?
Oh yeah, sure. So there is a follow-up paper, which is originally what I had planned, which was to show how to do data mining safely, to show how to do the statistics right. You might have heard of like multiple testing adjustments, and a lot of times people talk about multiple testing adjustments just to say that we should be more cautious about statistical significance. But the flip side of that is multiple testing can actually be used to correct for the bias, to tell you that, well, this return that you've selected from the right tail, it's not 100 basis points per month. It's more like 80, and it'll actually give you that exact adjustment. And we have a paper. I have a paper with Chukwuma Dim of George Washington showing you how to apply those kind of methods.
Yeah, and I think looking forward, we want to explore more about the kind of like the ideas that get generated in these journals. So we applied kind of like either very, very basic text analysis techniques just to understand if these papers were mentioning more concepts related to risk or behavioral, etc. But most of the heavy lifting we did ourselves by reading the papers and reading how the original authors, would classify its paper, if it's risk, if it's like mispricing or something else. So something that's now possible with these large language models is kind of like dig through more or how these investment ideas get spread. Like maybe, sure, like value started as let's say as an anomaly. Well, I don't know by now. Like size started being agnostic, like people didn't know why. And then suddenly the popular literature in finance started to putting it more and more into the risk category, right? So we're interested in a little bit of that, trying to apply these large language models to follow the evolutions of these strategies.
Alejandro, Andrew, thank you guys very much for coming on. I think it was a great discussion. I think we kept it pretty high level, and I think our audience, is gonna learn from this. So really appreciate it, and the door is always open for you guys to come on and talk the research and the things that you're doing. So thank you.
Yeah, thanks so much for having us on. It was fun.
Thank you so much. I love this podcast. It's always nice to speak about asset pricing. I love this type of conversations. Thank you.
This is Justin again. Thanks so much for tuning into this episode of Excess Returns. You can follow Jack on Twitter at @PracticalQuant and follow me on Twitter at @JJCarbonell. If you found this discussion interesting and valuable, please subscribe in either iTunes or on YouTube, or leave a review or a comment. We appreciate it.
Justin Carbonell and Jack Forehand are principals at Validity Capital Management. The opinions expressed in this podcast do not necessarily reflect the opinions of Validity Capital. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Validity Capital.